In the upcoming years, are you going to retire? If so, do you believe that your current situation suffices to support your way of life? Congratulations if you replied yes once more, but you should definitely keep watching if you want more. Nevertheless, before we get started, please click the like button, subscribe, and enable notifications if you enjoy this kind of information in order to stay informed about all that Tesla stock news has to offer. According to a groundbreaking analysis, its stock price might soar to an astounding $1,000 per share by 2026, significantly beyond its current worth of about $200. Based on projections over the next 5 years, there could be a $1 trillion opportunity in autonomous driving. Tesla would be in the lead if they could capture even a small portion of this enormous market. Thus, what would be your bet on this automotive giant if you were to buy in Tesla shares at current moment? In the field of electric vehicles, Tesla has emerged as a leader in innovation. In addition to producing outstanding items, the company also wants to make them as affordable as possible, and more revolutionary advancements are in the works. With these lofty objectives, Tesla looks set to overtake all other automakers in the world by sales in 2026 or 2027. Investors may choose to raise their investment rating from a hold to a more bullish bond, given Tesla's present values and outlook. Let's investigate why. Hi everyone, and welcome back to Tesla Tomorrow and the ever-growing electric vehicle sector. Despite the introduction of several competitors, Tesla has been able to maintain a significant market share. Over time, Tesla has maintained its position, and as the market grows, its dominance is probably just going to increase. Tesla has demonstrated that it is a very profitable company in contrast to some of its competitors who have financial difficulties. As a result, its stock is a desirable long-term investment. Tesla has completely rewritten what it means to be an automaker. Beyond making electric cars more widely known, the company has completely changed the way that sales are made by issuing traditional dealerships in favor of direct-to-consumer marketing. Furthermore, Tesla has eschewed traditional advertising in favor of obtaining press attention and utilizing word-of-mouth promotion. With its premium brand image, Tesla has soared to new heights thanks to these audacious bets that have paid off handsomely. Tesla continuously creates strong demand from customers while cutting costs that traditional automakers ignore. Industry analysts predict that during the next 12 months, the average price estimate for Tesla stock will be approximately $218.95 5 share. But while some forecasts fall to just $33.33, leap to $430.33, 3 cents 3, 3 cents 3, cents 3, cents 3. Let's talk about the money side of things now, though. The average monthly cost of living in North America is about $3,000. After accounting for additional ancillary expenses such as travel and medical bills, this amount comes to about $5,000 a month or $60,000 annually. Therefore, you would need about $2 million to live well for the next 33 years. What does this now mean for Tesla's share potential and your retirement? Given Tesla's present market value, it appears likely that this stock will be a wise investment in the upcoming years. It is anticipated that Tesla will keep growing for a number of reasons. In the near future, investors should be aware of two potential catalysts that might have a significant impact on Tesla. First off, as demonstrated by the exceptional delivery figures, there is a clear indication of higher than anticipated vehicle demand. Furthermore, Tesla is outperforming analyst estimates in terms of profitability at the gross margin level. These encouraging trends are promising for the company's financial future. One of the main reasons for Tesla's optimistic long and medium-term view is the possibility of a sharp rise in the rate at which electric vehicles are becoming more and more common. Although the market's current projections for EV penetration in the US by 2030 range from the mid-40s to the mid-50s percentage points, and demand. The firm's research study indicates that automakers might have far greater goals in mind. The survey states that by 2030 or 2035, most automakers want to have 100% of their sales come from electric vehicles. This suggests that analysts may have been unduly conservative in their projections, allowing for favorable surprises in the future, which would be advantageous for Tesla as the industry leader. Future success for Tesla will depend on more than just rising auto sales. Over the years, the company's revenue from other firms and its services has grown significantly. In the future, there will undoubtedly be more space for growth. For instance, Tesla has significant potential for supercharging revenue. According to a Goldman Sachs research paper, Tesla may see an increase in income of $1 to $3 billion in the next years if it allows all EV drivers to use its supercharger network. Given these aspects, it is anticipated that Tesla's profits per share (EPS) or bottom line will increase quickly in the future, possibly even surpassing its growth in revenue. The possibility of a capital return to shareholders and operational leverage are the main drivers of this optimistic forecast. In the third quarter of 2022, Tesla's capacity to profit from positive operating leverage is clear. Tesla demonstrated its ability to raise profit even in the face of a relatively small 2.3% increase in operational costs relative to the company's noteworthy 55.9% revenue increase. This is an example of how positive operating leverage helps Tesla's finances. Repurchasing shares of the company is another way to increase its potential EPS growth in the future. In their Q3 2022 earnings call, Tesla highlighted that they had the ability to repurchase between $5 and $10 billion. With 491,000 cars sold in the US, Tesla has made ripples in the market even in the worst-case scenario. Consequently, Tesla has surpassed BMW, which had held the top spot for the previous 3 years, to become the US leader in luxury automobile sales. BMW sold just 332,388 cars in the country in 2022, dropping them to second place. In 2022, Mercedes-Benz ranked third with 286,764 sales, and Lexus finished in second with 258,704 sales overall. Not only did Tesla surpass these well-known companies, but it also made history by being the first American car maker to be ranked 1 in 25 years. Going forward, it is anticipated that Tesla's unit sales in the United States would continue to rise, with $20.69 billion in estimated revenues in 2023. It is also expected that the company would continue to grow at a rate of 3.97% per year, which will lead to a predicted market volume of $19 billion by 2027. Morgan Stanley analysts see an appealing entry position in the current upward trajectory of Tesla shares. The company had earlier changed its price target from $330 per share to $250. This change was made to account for the possibility that Tesla may not be able to provide the anticipated demand for EVs in the future. Jonas, an analyst at Morgan Stanley, recently reaffirmed his overweight rating for Tesla stock. Jones thinks Tesla has a chance to succeed even with the EV market's intense competition. He says there's a strong chance self-funded firms like Tesla that have created size and effective supply chains will succeed in this market. Due to its incredible growth, which has quadrupled in only 4 years, Tesla's stock price may reach an astounding $1,000 per share by 2027 if the firm keeps growing at this rate. 2022 saw Morgan Stanley, an expert, ventured a daring guess. Within 5 years, they said Tesla's revenue will top $300 billion and surpass that of both Ford and General Motors combined. Morgan Stanley predicts that by 2027, Tesla's revenue will surpass that of both firms combined, despite the fact that it may appear impossible for Tesla to beat such industry titans. Analysts predict that competitors of Tesla will see a drop in their marginal growth shares, which Tesla would absorb. They predict that by 2030, GM's unit shares may fall from 14.6% to less than 12%, while Ford's market share may drop from 12.5% to around 10%. By contrast, by the end of the decade, Tesla's wallet share might rise to 23%. Additionally, Morgan Stanley projects that by late 2026, Tesla would surpass GM's revenue share from new car sales, and by 2030, it will surpass Ford and GM's combined market share. Morgan Stanley notes that Ford and GM may continue to be relevant in the EV ecosystem, even with their expected $300 billion in revenue if they reduce their profitability. They do, however, issue a warning about possible hazards for these established manufacturers, including growing labor and material costs and the implementation and expansion of upcoming EV model launches. Although Tesla's stock has underperformed recently, the long-term picture is still favorable. Based on its forecast compound annual growth rate for key financial measures, Tesla is expected to maintain its rapid growth over the next 5 years. Furthermore, after the stock price spike early this year, Tesla's values have become more fair. All signs point to Tesla continuing to grow quickly, even though investors may have doubts about the state of the market and Tesla's capacity to continue making money on cars, even in a difficult economic climate. This idea is further supported by the predicted compound annual growth rate for its net profit, free cash flow, and top-line revenue. Thus, the issue still stands: is buying Tesla stock a prudent retirement investment? Please leave your comments here along with your assessment of Tesla. Additionally, make sure to click on the following video on your screen if you'd like to catch up on the most recent Tesla news. I'll see you over there.